Welcome, everyone. I'm Jeanette Pascal with the Small Business Investor Alliance. The SBIA is the Association of Senior Investment Professionals focused on the lower middle market, whose members represent the entire private capital ecosystem. SBIA is an alliance for professional networking, business opportunities, legislative and regulatory expertise, as well as critical market data. SBIA works on behalf of its members as a tireless advocate for policies that promote competitive markets and robust investment for growing American small businesses. SBIA plays a vital role in promoting the growth and vitality of the private equity industry and the small businesses it supports. It has been doing so since 1958. We're pleased to bring you our Lunch and Learn webinar series with today's topic, Acquiring Companies with Outstanding PPP Loans. Our educational webinars are designed to provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. A couple of housekeeping tips, please. If you have questions for our speakers, please use the questions feature in your GoToWebinar menu bar. We'll monitor this section and share them with our speakers. Any questions that are not addressed during the presentation will be answered soon after the webinar. Also, please use this feature to let us know if you're having any technical issues. Today's technical director is Ainsley Hoffman, who will reply with any suggestions. Please be advised that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at McGuireWoods. Today's session is possible because of the support of our longtime valued sponsor, McGuireWoods. The McGuireWoods private equity team addresses the unique intersecting needs of private equity funds and those doing business with them, to include institutional investors, family offices, investment advisors, independent sponsors, lenders, and portfolio companies. The McGuireWoods SBIC team has significant formation, transactional, and regulatory compliance experience, serving their SBIC clients soundly on a variety of issues. Today, we welcome Brian Bilica and Mark Krumkowski. Brian focuses on private equity and venture capital transactions, mergers and acquisitions, securities and corporate finance. He routinely works with independent sponsors and capital providers, including family offices, in all levels of the capital stack to put together lower middle market deals across a breadth of industries. He also advises emerging growth and early stage companies, particularly in the technology space, as they work to advance their business objectives and goals. Brian works to provide value just beyond just legal services by opening doors for clients through thoughtful introductions and networking opportunities. He has a significant experience in representing small business investment companies and rural business investment companies. He also regularly represents institutional investors, pension plans, and endowments making private equity, venture capital, and hedge fund investments. Joining Brian, we welcome Mark Krumkowski. Mark has represented investment funds and portfolio companies in all types of private equity and corporate M&A transactions. He also has extensive experience counseling fund managers in all aspects of fund formation and administration. He has developed a substantial practice in the areas of complex financings, mergers and acquisitions, and general corporate representation for private and public companies. He also represents regional and national banks in connection with private equity subscription lines of credit and related credit facilities. Mark is among a small group of lawyers in the United States who have significant transactional and regulatory experience with small business investment companies and rural business investment companies. Mark is chairman of the firm's fund formation, SBIC practice, and the community and regional banking industry team. Mark, it's my pleasure to turn the virtual podium over to you to get us started.
Thank you, Jeanette, and really appreciate, and first of all, I want to thank Jeanette and Brett Palmer and the entire SBIA team for having us here today. It's been a great partnership. Jeanette and I were joking before the call started that I think this would have been the 21st year I think we'd ended up deciding, based on trying to remember whether it was for those who've been in this program long enough, of whether it was a DC year or a Florida year. Used to alternate for the annual meeting, and in normal years we would all be in Florida at least some of us at 12:05 would probably be starting our first cocktail of the day. But really appreciate that we have the opportunity to be here with you today. And just really quick, just want to thank obviously all my partners at McGuireWoods. As Jeanette mentioned, and thank you for that intro. I head up the fund formation and the regulatory and SBIC team, as well as some community and regional banking efforts, both lending to funds, lending to borrowers, to portfolio companies, as well as investment work. As Jeanette mentioned, we have a significant healthcare team, as well as a significant independent sponsor team in Chicago and Dallas, as well as our other 13 or 17 offices now, including Charlotte and Raleigh, which are very active within the SBIC community, New York and San Francisco as well. So first of all, I'd like to thank everyone for that. Second, I think just want to jump into sort of what we're going to try to do today. I'm going to try to talk a little bit about some of the new guidance that the SBA has issued. And I think one of the advantages that McGuireWoods has is we really have, because of our depth of SBIC fund clients who are usually providing mezz debt, but sometimes are taking control of companies as well. But also our significant senior lending group that we have sort of two different views of how the companies and borrowers and lenders have been looking at these PPP loans and the acquisition and sort of the recent guidance. So I think with all of that, we'll turn to the first slide. And this is sort of our guideline of where we're going to go. So initial considerations. I think one of the things that we just want to sort of talk about, sort of how this all started, right? Back when sort of COVID hit, I ended up having a call with a few clients who are on the line today, and they convinced me that I should go become a bankruptcy attorney and stop doing deals. Luckily, I told them I was too old and too nice to become a bankruptcy attorney. And so really we've sort of jumped into the PPP loans and sort of how not only could they revitalize, but sort of maintain the small businesses. And obviously through the work of SBIA, we were able to get the exemption specifically for SBIC funds in their portfolio companies. So I think one of the things that we always are dealing with, and we dealt with on day one, was the affiliation rules, and thinking about who would qualify, as well as now that we're on the back end of this side, of sort of where are the reviews going to come, and what are they going to look like, and what are the sort of best practices, not to avoid the review, but to thrive in it and to obviously get maximum or complete forgiveness, right? Which is at the end sort of the key to the whole economics of the PPP loans. So I think one of the things that we want to talk about was the affiliation rules and giving the present effect. And in terms of this conversation today, as we start or as portfolio companies start the process of a sale or begin to enter into either non-binding or binding letters of intent, of being clear of sort of when the affiliation rules start to get triggered, and then sort of also looking at it and providing, I think, some pragmatic advice, generally both to lenders wherever in the stack, mezz or otherwise, senior lenders who are trying to navigate the overall forgiveness, which can be a slightly different process, and then either the target or the acquirer in these types of transactions. So I think with that, sort of turn over to Brian to talk a little bit about some of the sort of initial diligence and sort of run through part of some initial considerations.
Thanks, Mark. like Mark and Jeanette mentioned, my name is Brian Belick. I'm a partner in the Chicago office of McGuireWoods. But in terms of, I've been working with PPP with Mark from the get-go here. So we have been through all of the iterations and the sometimes frustrating developments that have occurred with respect to the program. But in terms of thinking through either whether you are a buyer or you are the PPP borrower that's looking to be acquired, I think there's a couple things that you should keep in mind as you're preparing for a sale and as you kick off the negotiation process, even as early as the letter of intent stage. So the first one is, if you think back to when you initially applied for your PPP loan, you probably jumped through a bunch of hoops trying to figure out which entities and which private equity funds you were affiliated with. As Mark mentioned, SBIA did great work getting a exception from affiliation for groups for companies that have taken an investment from SBIC funds. But importantly, it is worth noting that to the extent that you don't have an exception from affiliation, if your letter of intent is deemed to be an agreement in principle, or you sign definitive transaction documents that you were doing a non-simultaneous sign and close, there is a chance that SBA will find that the buyer and the PPP borrower are affiliates, which may impact your initial loan eligibility. And to remind everyone, there is mandatory SBA review for loans greater than $2 million, but SBA has the ability to review any PPP loan. And our assumption is that loans, PPP borrowers that have undergone a change of control are probably at heightened risk for potential review. In terms of thinking through the due diligence process that you as a buyer are going to want to see from your PPP borrowers, you need to think about the necessity certification that was made as part of the application. So when you're doing your initial diligence, you want to see things like board meetings, board minutes, written consents of the board, projections showing that at the time that they applied for the PPP loan, the business was forecasting financial difficulties or an inability to operate, shelter-in-place orders, other guidance from the CDC or the state that made the operations of the business either impossible or at a significantly reduced capacity or otherwise impacted it. Those are the types of things that you want to see in terms of the necessity certification. Obviously, there was also a lot of heartburn around subsequent guidance that SBA issued around the fact that the necessity certification was made in light of other capital sources available to the small business. It's worth considering there that if you were a buyer, a PPP borrower that knew that they were going to get acquired, there's probably some risk there in that you didn't need the funds because you could have gotten acquired earlier, or the funds are going to be used just to bridge you to a sale. So in those instances, what you're going to want to see is pretty clear record keeping that the proceeds were used, the PPP loan proceeds were used to keep people employed, to keep the lights on, and that absent the PPP loan, people would have lost their jobs, the business would have shuttered, it wouldn't have made it to a sale process. And obviously this all exists on a spectrum. So when we're counseling our clients, we're trying to get people as far to the safe side of the spectrum as possible, but every deal and every borrower has their own individual facts and circumstances, and so we're available to help you walk through those. The next consideration in the diligence process is the use of proceeds. I think everybody's aware you need to use 60% of your proceeds, the PPP loan proceeds, on payroll, and the other 40% can be used on rent, utilities, mortgage obligations, which are forgivable, and then there's a permissible use for other existing debt payments, which would not be forgivable. But from the buyer's perspective, you are going to want to see clean records of all of these items, because it's going to make the forgiveness process much easier. It may ultimately have an impact on forgiveness if someone hasn't complied. You're going to want to understand what the the employee head count on a full-time equivalency basis was for the borrower, sort of during the baseline period, and then what it was during the covered loan period. Those are both terms of art in the PPP process, but all of those things will impact the amount that is ultimately forgiven. So the cleaner your records are, or the cleaner the borrower's records are, the easier this process is going to be. And given the amount of likely overlap in an M&A transaction, the parties are going to be working together for a period of time, even after it closes, to address any final PPP issues. You want to make sure that's as clean as possible. The last thing to keep in mind.
Brian, just to add to that, right? One of the things is, like every, frankly, piece of negotiation between the target and the acquisition, the buyer and the target, is it also becomes a point of leverage, right? At the end of the day, were all of your documentation in order on day one, which makes it more likely on day closing or end of the year or end of covered period, and those can all be a variety of things that can move. Does that make it more likely that it will be fully repaid? And if it does that give more leverage to the target that they should get what I'll say full credit for that repayment? Or does it shift the balance back to the acquirer to say, we think there's risk, we need you to mitigate this risk, and here's how we propose. So I think those are the sort of the diligence then will drive a little bit of the negotiations, and sort of also put everyone in a position, right? Because I think probably equally on this call, we have buyers and sellers and providers of debt to buyers and sellers, but be able to evaluate what that risk is, and then how do you move forward, and how do you mitigate it, or how do you get compensated for it?
Yeah, good things to keep in mind. The last point in the diligence process is to understand you're going to want to get a copy of the PPP loan application, including everything that was submitted with the PPP loan application, because you want to make sure that the documents that were provided to the SBA and the PPP lender are at least match, or at least roughly match what was provided to you in your diligence process. Those are materials that are available to SBA potentially in any review. Look, we all know that buyers have an incentive here to paint a rosier picture to potential buyers than they do when seeking government assistance. But to the extent you start seeing material discrepancies there, you may have a problem with the necessity certification, especially if you have a PPP loan that's greater than $2 million and is subject to mandatory review. All of those books and records are available to SBA, and so you need to be cognizant of the fact that material discrepancies between the two, including one that paints a rosier picture, may ultimately impact whether or not the necessity certification was appropriate in the loan application. When you're thinking about this from the PPP borrower perspective, I think to Mark's point, this is a leverage. This is all a negotiation. Leverage is always in play. To the extent that you can present a clean books and records and have a really buttoned up process with respect to the PPP loan, you put yourself in the best position and the strongest negotiating position, so that you increase and we'll talk about how best ways to structure these deals, but at the end of the day, in all likelihood, a better outcome in the forgiveness decision for the company, likely results in additional proceeds to the seller, and just a cleaner process overall. It reduces the likelihood of subsequent audits, having to defend investigations, all of which just leads to a cleaner break and a cleaner process. So I think in terms of initial considerations, that's it. Ainsley, if you want to advance the slide. I think the next step is to discuss the recent guidance that came out, and Mark will take this, but it's important to realize that the activity we have seen thus far has been in fits and starts, in large part because PPP lenders, the banks themselves, have been very worried about this, the lack of guidance and the lack of certainty as to what consenting to a PPP change in ownership meant for the SBA's guarantee of these PPP loans. As a reminder, these are 100% guaranteed by SBA. They went out the door so quickly that it's unlikely that any real underwriting went done. So, can't really fault banks for being very risk averse in that respect. But we think this recent guidance provides a nice roadmap to getting to a place where deals can start getting done. So with that, Mark, if you want to take over.
Yeah, just quickly sort of run through the change of ownership and recent guidance. So 20%, at least 20% of common stock is sold or otherwise transferred. Relatively straightforward. Obviously, there's some nuances we can talk about later. The borrower either sells or transfers at least 50% of its assets, or there's an actual merger. And one of the things that I think sort of has come up recently is sort of trying to, what I'll say, meld the guidance, SBA guidance, with the SBA SOP, Standard Operating Procedure Manual, that sort of has existed. And some of it clearly was drafted for pure 7A loans, and doesn't squarely fall within the buckets that we're talking about here. So there's always a little bit of disconnect between sort of, I would say, sort of sometimes how the SBA has historically thought of something, or how they've described it, or how they've sort of approached it, versus the actual portfolio companies, the actual borrowers who generally were never taking 7A loans before now. Not always, but generally are not. And I think one piece that Brian had mentioned, just to reiterate, I think on the acquisition side, or even on the sell side, I think you also want to think about, was the PPP loan part of a larger senior debt facility? And so you had a senior lender providing regular term, revolver, et cetera, and then they added on a PPP loan. Or was it, so that's sort of what I'll call best case of sort of the whole picture, the whole debt stack, if I could use that term, coming together. Or were there some accounts with a senior lender, and then the senior lender provided that PPP on top of, or in addition to, and there were some carve outs with the senior lender, but it wasn't a brand new relationship, but there was an existing relationship. And then, so I think those are two categories work together, as in terms of, all right, how do we get to, was there some underwriting done, and how do we approach it, versus new borrower, new lender, maybe no other relationship, and maybe no future relationship with a lender either. And so I think the economics and the analysis is slightly different in those cases, as they sort of know that the repayment and the guarantee is their strongest underwriting, I think, one. But then two, there's been clearly a variety of sales of portfolios from PPP lenders to um, amalgamated lenders might be the best word for it, who have sort of formed pools of money to buy PPP loans. And so looking at those underwriting and how that might work, I think becomes part, maybe it goes back to the diligence a little bit, but becomes an important part of the diligence, important part of the whole process as it runs through. So those are some of the things, some of the recent guidance doesn't fully address, but those are the things that are in play as we think about, right, how do we look at this, what has triggered it, and then when do we need to go get SBA consent, and what that might look like, right?
Yeah. So change of ownership was given some clarity, which Mark ran through. But in any case, it's always worth taking a look at the SBA Form 7A loan note, which includes a list of events of default. But it's also important to remember that not every lender use the Form 7A loan note. So dust off the note that you actually signed in connection with your PPP loan, and make sure that whatever the acquisition structure you're looking at doesn't trip any other requirements. In any case, you're going to need the PPP lender consent, and this most recent guidance provides a pathway to ways to avoid SBA consent, and then what to do if you aren't ultimately able to comply with those options, how you proceed. So Ainsley, if you want to advance the slide. So there's the first one's the easiest one. There are no restrictions if the PPP loan is repaid in full, or if the loan forgiveness has been completed and SBA has either remitted funds to the PPP lender in the full amount of the PPP loan, or the PPP borrower has repaid any remaining balance in the cases of partial forgiveness. Where SBA consent is required, in terms of if your deal is structured as an asset acquisition, PPP borrower needs to complete a forgiveness application reflecting its use of all of the PPP loan proceeds. It's important to note that it's all of the PPP loan proceeds, and submits the forgiveness application to the PPP lender, and separately establishes an interest-bearing escrow account that is controlled by the PPP lender. So this indicates that you may need a separate, to the extent you have an escrow account with either the senior lender or the existing lender, or just a separate escrow agent, you may need a separate escrow account with the PPP lender that disperses the amount first to repay any unforgiven PPP debt after the loan forgiveness application is processed, and that includes the 1% interest that has been accruing, and then any remaining balance in the escrow account can be dispersed as agreed to by the parties according to the purchase agreement. Ainsley, next slide, please. For an equity sale, there are two instances when SBA consent would not be required. First is the sale or transfer is for less than 50% ownership of the PPP borrower. So if you recall, changes in ownership are triggered at 20% of the common stock or other equity interests. So anywhere between 20 and less than 50, you will not need SBA consent. Or if you're above 50%, very similar requirements, complete the PPP forgiveness application reflecting the use of all of the PPP loan proceeds, and submit it, and then establish a separate interest-bearing escrow account that's controlled by the PPP lender, where the funds are then first dispersed to pay any remaining PPP loan balance plus interest, and then any remainder can be dispersed in accordance with the purchase agreement. Next slide, Ainsley. So if you're unable to comply with either if you're unable to comply with the requirements for not seeking SBA consent, it means you're going to have to not only get the PPP lender's consent, but you're also going to need to get the SBA's consent. And this recent guidance is structured to discourage people from needing SBA consent. So in the event that you ultimately end up at a place where, for whatever reason, the previous options don't work for you, you will need to submit a request through your PPP lender that includes the reason that the PPP borrower cannot fully satisfy the PPP note or escrow the funds as required to avoid seeking SBA consent. And in connection with that submission, you're going to provide details of the requested transaction, so the change of control, change in ownership, a copy of the executed PPP note, any letter of intent and the purchase and sale agreement, disclosure of whether the buyer has an existing PPP loan and the loan number of the PPP loan, and a list of all of the 20% owners of the buyer. So this is a lot of information that creates a lot of extra risk that doesn't need to be introduced to the process. So we're encouraging our clients to do everything you can to comply with the requirements for not being required to go get SBA consent. So a couple of little landmines that are buried here. So you're going to have to provide the letter of intent and the purchase and sale agreement up front, which means that regardless of whether you are below the $2 million PPP loan threshold, you're basically submitting your PPP loan for a review by SBA. So they will look at the letter of intent. They will look at whether or not there was an agreement in principle. They will look at the purchase and sale agreement to see whether, if you were doing a non-simultaneous sign and close, whether this was signed before, the day of, or immediately after the PPP loan was applied for. All of those are potentially bad facts. You are bringing the buyer into the PPP loan process and requiring a disclosure of all of the 20% owners of the buyer, which created heartburn on the front end here when in the loan application process, all of the 20% owners of the PPP borrower, which in often cases includes private equity funds, are now listed. So there's a lot here to unpack, and a lot of ways that this could start to I don't want to say spiral, but make the forgiveness process and the transaction process much more difficult than it needs to be. And then once you comply with that, SBA review of the change of control process will be completed and the determination issued within 60 days. So just thinking through how that impacts your transaction process overall, we know that you can lean on a PPP lender a little bit to try and expedite the consent process. You will not be able to lean on SBA to expedite the consent process in the context of a change of control transaction. It just doesn't work that way. It's not the same type of commercial relationship. So it has the potential to be a significant gating item to push your timing out by up to 2 months. And so to the extent that you are looking at this, I mean, again, the guidance only recently came out a couple weeks ago. So to the extent you need to restructure your deal even to sort of fit it within the options that allow you to proceed without SBA consent, we think it's worth doing absent some extraordinary circumstances, because this has the potential to delay your deal up to 2 months. And given where we are in the year, that puts you at year end. It creates a lot of other complications depending on what you as the potential buyer have going on. So I think that's it for the recent guidance. We think this is a really useful roadmap, and was sort of the first real substantive guidance from SBA or Treasury on how to navigate potential potholes in an M&A transaction. There had been emerging best practices, but frankly, those were just educated guesses. This is the first real roadmap. Mark, I don't know if you have anything to add on this piece.
Yeah, the one piece I would add, I would sort of, let's put it the sort of pragmatic caution or Scrivener's caution to everyone. when we think about the letter of intent to what I'll say draft with a purpose, and that really at the end of the day, both from the acquirer, but also from the target portfolio company, that making sure, knowing that that is going to be shared, making sure that is drafted the best that it can be. And sometimes that's maybe a cleanup before the final term sheet is executed, but also thinking about how sort of along the way those terms sometimes change. So I put that out there just to, because it's, let's be honest, absent your lawyer saying, well, this is not what was in the term sheet, and the client responding, well, we all agreed to something slightly different after the term sheet. That's great, happens all the time. No one ever really goes back to the term sheet or letter of intent, I should say here. And how do you think about that, and knowing that that will be shared, and then how much is that really going to be reviewed? So I think that's one little pragmatic piece. I think the other that we didn't really talk about, I think it's, I'm going to say it because I think it's on top of mind, is not every buyer is equal, and not every seller is equal, and not every industry is equal. And what do I really mean by that? I think there will be certain industries that may get more scrutiny. I think there may be certain buyers that get more scrutiny, and maybe even some sellers, right? We've seen that sort of along the process. We've seen that, we can argue about whether it was right or wrong or indifferent, but we clearly saw a variety of portfolio companies return PPP loans who clearly, in my mind, based on the information I have, were eligible for them. But there was political pressure or business pressure or some combination thereof, right, not to take it. And so I think, for as much as we like to give you certainty that all the rules will be followed, I think at the end of the day, I think there is some risk that there'll be some changing of the rules along the way, because we have seen that, frankly, from day one. And there will be, as we all know, it is still very much a living document, to borrow a constitutional phrase. And so things, right, today, new legislation could be passed and approved, which modifies this. The guidance is only really valid until new guidance is issued. Does any change of administration change that? Not here to try to read tea leaves on that. Generally changes of administration don't change these types of programs, but there's no guarantee, and we are still in 2020, so everything is up for grabs in 2020, right? So I think all of those things, but just thinking about that from whatever side of the transaction you're on, I think that there is some risk there, and I think lenders appropriately are hesitant to take that risk, and they were put into a program and encouraged to be put into a program to offer these PPP loans, and they're not in the position that they want to take additional risk, as they were sort of told this was part of their civic duty. Because I think we all can sit here and agree that senior lenders are not making any money on these PPP loans, both from the pure cost of them, the rate, but also the administrative burden, for lack of a nicer way of saying it. This is not a moneymaker for them, and they certainly don't want to lose money on them. So I just put those out, one, the letter of intent specifically, but also I think thinking about the industries, thinking about the buyer and seller, and how that might get reviewed. I think it will be a important part of that, again, that negotiation leverage, who has it, where are we? So I think that's it, Brian. I'll turn it back to you.
Yeah. So we got a question here in the interim that's worth addressing now because it's relevant to the recent guidance. So the gist of the question is, can you pay off part of the PPP loan so that when you apply for forgiveness, in order to fit your application within one of the exceptions to needing SBA guidance, your forgiveness application reflects the use of all of the outstanding PPP loan proceeds rather than all of the original PPP loan proceeds. And of course, as has been the case with much of the PPP guidance to date, answering all of the questions that this guidance did creates new questions like this. It is so it's unclear. However, if you think about what the parameters are intended to address, if you were to prepay a portion of the PPP loan first and then apply for forgiveness showing the use of all of the outstanding PPP loan proceeds, we think you've made a good faith argument that you've complied with the recent guidance. Is it ironclad? No. Will your PPP lender push back on sort of this argument? Perhaps, because again, it moves them into the gray area a little bit, which they are going to just be uncomfortable with anything that's not sort of black and white. But we think that that would be the pathway for those people who ended up not needing all of the PPP loan proceeds, or it just didn't work out where you were able to spend it. Stay tuned on that front to additional guidance. It's also worth noting kind of where we are in the process. The forgiveness portal is open. It isn't open for every bank or every client of every bank. Some banks are staging this where, a portion of their PPP borrowers have access to that bank's forgiveness portal on a rolling basis. So not everyone has had the chance to apply for forgiveness, but some have, and we are starting to see SBA even remit funds where forgiveness has been granted. Granted, they appear to be smaller amounts, kind of on a test basis, but suffice to say that we are going to start seeing a market emerge as to how these are being treated. So that may be a way that we get some guidance on this question specifically. It may not be explicit guidance from SBA, but it just may be a course of conduct, something that we see as having been approved in other deals. So, best guidance there is if you can make the argument to your PPP lender that you're complying, that I would go ahead and proceed on that basis. Ainsley, next slide, please. So now we've got about 17 minutes left, and we're also happy to take questions submitted online to the extent we have time. But in terms of now that you kind of know what the initial considerations look like, what the guidance is in terms of how you should structure your deal to make it the most efficient deal possible, where you sort of avoid SBA consent, which can be a delaying factor and introduce new risk. How should you actually structure your transaction? And there's a couple buckets worth talking about. So first is purchase price adjustment. This one, we've seen a variety of different outcomes here. We've seen the buyer insist on just having the PPP loan repaid, and the buyer's just not going to deal with the forgiveness process. That's one extreme, on the more extreme end. Where people typically end up is on a cash-free, debt-free basis. You treat the purchase price as and the PPP loan proceeds that are forgiven as cash that comes out of the business, and the PPP loan unforgiven balance is debt that needs to be repaid at closing. And so you just need to create a new structure, a new mechanism that allows for that to take place. It's a combination of a typical purchase price adjustment mechanism with a separate escrow, which is the next point. Obviously, you now know that in order to be exempt from seeking SBA consent, you need to establish an escrow in the full amount of the PPP loan. It needs to be in an interest-bearing account. It needs to be with the PPP lender, and in all likelihood, this is going to be in addition to any other escrow accounts that you have, be it an indemnity escrow account, be it a members representative reserve fund, or a purchase price adjustment escrow account. So this creates additional work. It creates one more thing to keep track of, but it's pretty cut and dry in terms of if you want to be exempt from SBA consent, you need to establish this separate escrow with the escrow agent being the PPP lender. To the extent you have a non-simultaneous sign and close, you are going to want some covenants around the operation of the business during the interim. Use of the PPP loan proceeds. Obviously, you need to have a covenant around using the loan proceeds for permissible purposes. In all likelihood, it makes sense for the borrower to prioritize forgivable purposes ahead of not just permissible purposes. Again, forgivable purposes: payroll, rent, utilities, mortgage obligations. Permissible purposes: regularly scheduled debt service that existed before, I think, February 15th of 2020. So prioritize forgivable purposes, but all uses need to be permissible. Who controls the forgiveness application, and then how are the parties going to interact in terms of any subsequent audit or appeal? Generally, we recommend, especially if you're the buyer, having the seller control the forgiveness application, having the seller sign the forgiveness application to fit within the exception. The seller needs to have submitted the forgiveness application before you can be exempt from consent anyway. But generally speaking, the buyer probably doesn't want to be certifying for actions that took place on the seller's watch. Audit and appeal: if there's an SBA audit or review, or there's a desire to appeal the decision from the SBA, you probably want, if you're the buyer, you can structure this so that, look, it is what it is. The determination of either, partial or complete non-forgiveness is what it is. You release the escrow and you're done. Seller's probably going to have some different thoughts and is going to want to defend an audit, respond, and potentially file an appeal, because in all likelihood, any benefit there is going to accrue to the seller. So you need to think about things like who pays for that, what do the cooperation covenants look like, what is commercial reasonableness in this instance. And then there's, a typical further assurances, and this wouldn't be in any further assurances should just be, and same with actually controlling the audit and appeal. This would be in any deal. It would be a sort of a post-closing covenant. You want the ability to have the other side cooperate in anything, any sort of unforeseen developments or new guidance that comes out after the closing that ultimately applies to this deal. In terms of reps and warranties that you want built in, again, this is in any deal, simultaneous sign and close or otherwise. Information contained in the loan application, the initial loan application, true and correct. The necessity certification was true and correct. Loan proceeds have been used for permissible purposes. Books and records maintained in connection with the PPP loan are true and correct. The loan forgiveness application and the information contained in that is true and correct. Make sure that you're including in these reps and warranties information submitted in connection with the loan application. So if you define loan application, it needs to be more broadly defined. This sort of plants the flag for potential indemnification claims. You want to make sure that especially in instances where when you were doing your diligence, the PPP borrower didn't have everything buttoned up completely, maybe a little bit messy of a process in the application period, or sloppier record keeping on the use of proceeds. Lower middle market companies, we all know that the degree of sophistication varies significantly. So having good reps and warranties then sort of allows you to have valid claims for indemnification. So
and Brian, one thing
go ahead, Mark.
I'm sorry, one thing I'll add on just on that one specific piece, again, very pragmatic. I would say anyone who received a PPP loan in the first 30 days would also fall in that category, whether sophisticated or not, because the rules were changing, unfortunately not every day, but every other day, and usually at 9 o'clock at night, stealthily, posted. And so, and for those who didn't live through that process, the SBA would post some FAQs, which you've probably all seen, but would also post additional non-guidance guidance along the way, and not always being clear what they were updating or what they were modifying. And so I would say, through no fault of any lender, but certainly no fault of any borrower either, the rules were changing on a daily basis. And so I'd put anyone sort of in that maybe 30 days, maybe it's 45 days of the first issuances of the PPP loans in the, I won't say higher scrutiny, but I think thinking about it a little bit more, thinking about those records. There's a little bit of a nuance here is, as a technical matter, some of the rules apply. You were able to apply based on the guidance that was available when you applied. And so that becomes a much harder discussion along the way, but I think one that, just to point out to folks here. And so just add that to the piece, besides, I won't say the unsophisticated portfolio company, but the ones that could have a little bit better books and records, certainly. So I'll turn back over to you for the last piece.
Yep, and just to piggyback on what Mark said, so as you're doing your diligence, if this was an early PPP loan, there's a chance they may be through the covered loan period, which was 8 weeks. There's also a very good chance that they may have the 24-week covered loan period, which they may be, you may be getting close to, or you may be all the way through. It's worth focusing on around mid-May, which is when the sort of guidance on the necessity certification came out, and seeing if the borrower reevaluated its need for the PPP loan. If any of you recall, you had the opportunity to return your PPP loan proceeds in light of the new guidance by, I believe, something like May 19th was the ultimate date. And that would be it. Everything would have been deemed to have been, every act would have been deemed to be in good faith, and you would just be excused from the program. So to the extent that there's a second set of board minutes around mid-May, or additional projections, or any kind of books and records, that's another time period to keep in mind. But then in terms of getting back to sort of drafting best practices, in terms of indemnification, obviously you'll just build in typical escrow release provisions for any portion of the debt that's not ultimately forgiven. But ultimately, as the buyer, generally you should seek standalone indemnity for anything related to the PPP, may treated as uncapped, or subject to a separate cap and basket, to cover things like making yourself available to respond to the audit, because you are going to be controlling the company when this audit is proceeding, and it is going to cover a time period that in all likelihood was solely controlled by the seller. So you're going to need to cooperate. That is going to cost the buyer time and money, and you should have an indemnification provision that covers that. Civil and criminal penalties, there's guidance that says, if you just return the money, let's say SBA reviews the PPP loan and says the necessity certification was improper, you just return the PPP loan proceeds from the escrow amount, and you're done. You can deal with any appeal, but but effectively civil and criminal penalties won't extend past that in those circumstances. Obviously, there's a few bad apples in every basket, and so I'm sure many of you have seen the guy who took his PPP loan proceeds and went and bought a Lamborghini. There are going to be instances where outright fraud will result in civil and criminal penalties. Obviously, your diligence on the front end should uncover that, or should uncover that in many cases. But nobody's perfect. Things slip through the cracks from time to time. And obviously, as a buyer that had nothing to do with that, you want to make sure that you are covered from any civil and criminal liability. I think that's it, Ainsley, if you want to go to the next slide. We did receive a question whether or not a copy of this presentation would be available. It will be on the SBIA website following the presentation. It may take a day or so to get up there. But otherwise, that is all we had. It has been a pleasure speaking with you today.
I'm sorry, Brian. The one thing I was going to add, and then I will let you wrap up, is I think one thing that we have done, and look, I understand that this is not always the easiest thing to do, but the one thing we have done is sort of come into a deal, and this is certainly a commercial, but it's the reality, and the reality is not that many firms know this, is come into a deal and sort of done an evaluation. We're not going to issue an opinion that everything looks good, but I think we can come in and I know we can provide value to make sure, whether you're a buyer or seller, or frankly, even the mezz lender in between, but you're getting paid out, that the ultimate protections are there and that the deal is reached. And that, look, that is not something that's, what's a nice way of saying this? We're not here to be specialized plumbers, but the reality is we're really good at what we do. And Brian and his team and the various teams throughout our firm sort of have done this and can help people get to the right place. And the PPP repayment, although is an economic risk, should not really be a risk that craters a deal, right? Generally, they are not, right? They're not of a significant amount that they should kill a deal, but they're also not, they are material. And whether that materiality is $500 or $1 million for some of the smaller ones, or whether the larger ones, obviously up to 10 million, those are still material loans, and they certainly impact the purchase price and sort of how you look at the deal going forward. So I think that's one thing that I'll just very pragmatically add, that we can come in and look, we'd love to do the whole deal, as everyone I think on this call knows, but there's sometimes a deal has started and now everyone's saying, well, we're not sure what we're doing here, and we're not sure, our attorneys have really dealt with the PPP loans besides in the abstract, and how do we sort of solve this problem? And I think, as Brian said in the intro, not only making introductions, but I think trying to solve people's problems, because we're here to get deals done. And that's, at the end of the day, why we enjoy being regulatory lawyers, but more importantly, we enjoy being transactional and fund formation and overall transactional attorneys to help get deals done, frankly, to keep, the business of America moving forward and the private equity firms doing new deals. So I'll turn it back over to you, Brian, I'm not sure if we had any, I know we had some additional questions that we'll have to answer after the fact, but I'll turn it back over to you, Brian, to wrap it up.
Yep, thanks. This is an evolving landscape, as we mentioned, sort of throughout. There may be additional guidance explicitly that comes out, but there also may be sort of course of dealing or a market, solution that evolves and becomes generally accepted over time. So it matters having someone that is dealing with this on a day-to-day basis, involved in the transaction. And as Mark, put it, we play nice with others. We're happy to come in help out on this piece to the extent you've got something that's already underway. And obviously we'd love to work with you all from the start. But if there's anything we can do, questions we can answer, please do not hesitate to reach out to either one of us. We're happy to talk to you. And once things normalize, we look forward to seeing all of you at the next SBIA in-person event that's not golf related, because I'm a terrible golfer.
Thank you, Brian. Thank you, Mark. We look forward to seeing you all soon. Thank you, everybody, for being here today. We do appreciate the time and expertise that Brian and Mark so graciously shared with us today. As Brian indicated, a replay of today's webinar will be available along with this great outline that they provided to us. It'll be available to SBIA members and will be available on our website very soon. Our next Lunch and Learn webinar is scheduled for Wednesday, November 4th. This session will feature an exploration of navigating distressed companies. And as Brian indicated, we are doing some small group networking outings around the country. SBIA designed these so that people can get together in a small, safe, friendly setting. We hope that you'll consider joining us at one of those. And while the registration for this year's virtual Capital Links has closed, be on the lookout for future announcements. A lot of you know that SBIA's Capital Links is a strategic matchmaking platform that introduces institutional investors and lower middle market funds. This provides an exceptional networking opportunity for GPs who are actively fundraising or going out into the market soon, and for the quality LPs who are members of our associations that are looking for fund managers to invest in. So stay tuned for details on programs that are specifically designed for those who are fundraising, and then also for those who are looking for quality investment opportunities. So please be on the lookout for that. If you're not an SBIA member and would like to learn more about joining the organization, please contact Alex Frick in our office at 202-628-5055, or you can email Alex at membership@sbia.org. We need to add your voice to SBIA's and look forward to having you join us. SBIA.org is where you can find more details. Thank you all again for participating in today's webinar. We look forward to having with you on the 4th. And Mark, Brian, sincerest thanks. It's always good to be working with you. And we look forward to seeing you real soon in person. Thanks, everybody. Take good care. Bye now.